All right, well, I've got five after. So why don't we get started? Laura, would you be so kind as to introduce Joe for us?
Yes, yes, with pleasure. Well, hello, good afternoon. Thank you so much for letting us be a part with the Intel community. And I know a few non-Intel people are here as well. So it's an honor. We've known Daniel for about the last 12 months now, and it's taken us a while to get here, but we're honored to be here and we appreciate you all joining. So today we're going to explore the explore the power of passive investing in real estate and equip you guys with the knowledge and strategies that you need to choose the right real estate project and sponsor to invest your hard-earned capital. Today, Joe is going to go over how to assess a real estate project effectively, how to select the right sponsor, how to master due diligence and mitigate risk. And yes, we are going to cover this in the next 35 minutes. It is not just an opportunity today to enhance your knowledge, but is a chance to empower yourself as an investor. As we all know, real estate can be a lucrative avenue for wealth growth. So it is my pleasure to introduce to you today Joe Burko. Joe is the CEO and founder of Astor Realty Capital. He is a nationally recognized entrepreneur with a track record of over 28 years of success in commercial real estate finance and investment banking. His career has included founding Burko and Associates in 2005, which is the brokerage arm of our firm, the firm that I originally started working for 11 years ago, specializing in investment sales, structured financing, and syndication. His approach over the years and his dedication to ethical investing have actually earned him prestigious awards. He's been nominated the Power Broker by CoStar and New York Signature Broker by Globe Street. He also served on the New York State Real Estate Board for 9 years and was appointed by 2 New York governors. So he's dedicated to education, dedicated to sharing his wealth of knowledge with individuals such as yourselves who are looking for a safe and secure investment. So I'm proud to pass you over. Joe, I'm going to share my screen. You don't have a clicker, so give me a little Queen's wave when you are ready to move onto the screen, and I will move it on.
One of these, you'll change
Beautiful. Beautiful, beautiful. You did her proud.
Very great. Thank you for that, Laura. And thank you very much, folks, for having me here this afternoon on a Friday. We're coming to you from Miami. Laura's in Colorado. And then the rest of the team is where? I heard Phoenix at one spot, right? Yeah, I think one of the teammates is in Phoenix.
Primarily West Coast based, Washington, Oregon, California, Arizona, Texas.
Awesome. Very, very great. Well, good to be here. And, we're going to focus today about real estate investments, right? We'll have a conversation focused on, I'm sure you get a lot of emails, just like a lot of us, a lot of opportunities out there, whether it is coming from a crowdfunding site or coming from local friends who knows a guy that's building something, buying something. It's always somebody talking about real estate. It seems like it's the most interesting topic of conversation around the dinner table. People love real estate. They love bragging how much money they make in real estate. And like everything else, it's a cyclical industry. You want to know as much as you can about who it is you're investing with, why you should be investing, what strategies you should be deploying. And my job today is to try to the best that I can utilize some of my close to 30 years experience in this business since 1995 and share with you a little bit from my experience on how we make allocations into commercial real estate. So, like I said, I've been around the block for now 28, close to 30 years in the world of commercial real estate. Done a lot of transactions, over $4 billion worth of transactions, both as an intermediary, in other words, as a commercial real estate broker, representing public company, family offices, individual groups, you name it, in the acquisitions, the dispositions, capital raise, capital placement in commercial real estate. I've represented the state of New York for about 9 years in the world of real estate. I've got all sorts of nominations and, I've been around the block for quite some time, or as we sometimes say, as we get closer to Texas, this is not my first rodeo. Laura, when I go like this, we'll change the slide. Okay, and we can go on to the next one. Right now, our fund, Astor Realty Capital, manages or participates in excess of 3.6 million square feet of prime real estate in 12 gateway cities, major markets, 7 states. And in our portfolio, you can find anywhere from high-end hospitality, what we call lifestyle hospitality. In Phoenix, we have participating right now in the Caesar Republic. It's a gorgeous hotel on 265 keys. We're like 4 months away from completion and opening this wonderful asset that sits right in the heart of Scottsdale, right to the Fashion Square Mall. We are investing in lots of ground-up projects, multifamily projects. We're investing in all sorts of mixed-use condo projects, so on and so forth. We invest in debt. We place debt. We allow our capital to actualize transactions through as a form of becoming a lender. And so each and every one is his own strategy. Why we deploy those strategies, why we look at over 800, 900 transactions a year, but only say yes to just about 1 or 2% of those, is maybe going to be the topic of this discussion. Continue to the next one, please. And we can skip this one. We just covered the geographical expansion. Our portfolio mark to market is $2.2 billion. And as I said, we're all across the board. Judging by everything that was going on to date, I mean, we went through some very bumpy ride since 2019 into 2020, where the world shuts down. And, when real estate goes up, everybody makes money. It's kind of like easy. Everyone's smart. Really, the test is what happens when the market starts going this way. That's the story of the last several years, with maybe a little bit of a year and a half break between early 2021 into kind of like early 2022, where the market kind of like went like a hockey stick, went on fire. But overall, if you look at our portfolio, we're averaging around 21% return on equity as a net return to our investors, right? But before we'll dive into how we make allocations, I want to start getting into the psyche of understanding where we are, right? Real estate, like everything else, is a very cyclical industry, right? There's ups, there's downs, there's peaks, there's valleys. Usually the valleys, which is where we are now, and we'll discuss why, is when we as professionals want to go into the market. It's the most kind of like contrarian times. It's the period of time where a lot of people sitting on the sidelines, they're not comfortable to go into the market. They're not sure where the economy is going. Conversations about the second shoe's about to drop and all sorts of different conversations. Certainly, you want to be very, very picky, and you want to be very careful when you enter. You don't want to enter too close to a beginning of a bottom. You want to know that there's some signs that we're sort of like, reached the bottom, all right? And in my opinion, we are, and let's talk about it. Let's go backwards right now to March of 2022. It was the first time the Feds announced that it's time for them to start pushing on interest rates because inflation is starting to move. It's starting to become rampant. At that time, inflation was around 4 or 5%. And so the Feds recognizing that something is moving and their job is twofold, right? Keep inflation at check and make sure that people are employed, right? That's their 2 main jobs. The Feds decided to start increasing interest rate with an interest of about 50 basis points. A month later, they've increased it again by another 50 basis points. At that moment in time, kind of like early May of 2022, we've stopped our operation. I called a meeting at the office and I said, guys, we're not going to deploy any more capital until we figure out what's going on. The Fed is out there with a baseball bat trying to erode values. And so if we look backwards, the peak of the market was March of 2022. It's been now 11 consecutive raises of the Feds month over month between 50 basis points, 25 basis points. And inflation kept on climbing until it reached a peak of about 9.6%. Okay, sometime around November of 2022. A very, very scary time. So at that point, we've stopped operations. We've gotten a lot of requests to participate in many very different projects. We said, absolutely not. We're taking a chill pill. Right now, it's time to hold and let the market recalibrate itself. Okay, the market absolutely needs to recalibrate itself. It takes the real estate market a lagging 6 months to as much as 2 years to figure out how to adjust pricing. Real estate is many things. One thing is it's not quick, right? It's not the stock market. It is an inefficient market. And inefficient in the sense that if I buy a stock, I can go right now to my cell phone, open up whatever program I use, and whatever Apple stock is trading for, you will know the exact same price at the exact same moment. It's an efficient market. Real estate is an inefficient market. What I know, my knowledge is unique to me. I know about a property for sale or a land that's thinking with my neighbor's land is looking to trade it in the next several months. It's unique information to me. It's not always available to the market. And so inflation, actually have a very, we have a very negative impact, of course, on valuation, because one of the things that inflation impacts is interest rates. So as inflation is going up, Feds are pushing up interest rates, and then cost of capital becomes expensive. How much expensive? I'll give you one example. In March of 22, we've acquired an asset in Dallas, 205 apartments, complex, 36 buildings. And we have signed a loan of 3.6%, right? Adjustable, right? That's where it gets risky. Adjustable loan, simple project. We were able to find something that at the time looked great. It was around a 5% cap rate with a big upside potential, right? Our average apartments in that complex in Dallas was paying around 98 cents per square foot, okay? Less than $1 per square foot. What does it mean? 2-bedroom, 1,000 square feet, 2 bedrooms was going for $1,000. At a market that was around $1,400 and showing signs of additional room for growth. And so the business plan was very, very simple. Buy the asset, get an adjustable loan, push the rents up to market from $1,000 on average to $1,400, $1,450, and then exit within 2 years, possibly 3. And that's March 2022. The loan we signed was 3.6%. Within a couple of months' time, we found ourselves in a very different territory. Within 6 months' time, our loan is nearly tripled, $20 million, right? At 3.6% versus $20 million at 7, 8, 8.5% is a very different conversation. Let's just think about the math. What we did as reasonable operators is we bought an insurance, also known as rate cap, right? So we bought an insurance and we said, look, 3.6% is a great rate. What happens if the rate starts declining, start increasing? And so we bought a rate cap. So we capped it off at 5.75. And that's, I think, what saved us. And that's the story of, the multifamily today that are having rate caps that are expiring. Right? So imagine if we didn't have that insurance, obviously that insurance is costly. If we didn't take that insurance, as a lot of people didn't, they found themselves in big trouble right now. Let's go next slide, please. And so let's talk about multifamily absorption in general and why we like multifamily. In 2023, we found a very strong absorption, nearly 100,000 units were absorbed. And the same is going to be in the second half of 2023. We're looking at the same numbers. While all asset classes are in a decline because of cost of capital, right? Overall, from peak to trough, and I believe we're at the bottom, but from peak being March 2022 to where we are at the bottom right now, on average, I call all asset classes, that is hotels, multifamily, that is logistical centers, retail, industrial, you name it. Right? Everything altogether is now down about 20%, of course, with some areas, some sectors that are getting decimated. Office, right? Those of you or know a little bit or track a little bit about the world of office, you know that in California, it's mainly downtown LA or San Francisco, it's very, very hard to keep an office building. It's very hard to even understand what the value of an office building is in those locations. It's not uncommon to see drops in value that are in excess of 80%, right? In other words, some of the trades that we've seen in places like California and something like downtown LA or San Francisco, the very few trades, if they haven't already returned back the keys to the bank, if those trades have happened, they probably happened at about 20 cents on the dollar and sometimes maybe even less, right? It's a very, very hard conversation right now, a whole different sector. But considering all sectors combined, we're talking about a big drop of about roughly 20%. Multifamily, being a solid asset class, is not immune, right? Is not immune. If I have to buy a multifamily today and my cost of capital is 6.5% or 7%, then I'm going to find an asset that will be roughly generating for me a cap rate somewhat close to that amount. Maybe I may not be able to reach a 6.5 or 7, but certainly I'm going to pay a lot less than I did 18 months ago or 2 years ago. And so we like multifamily because the absorption, the demand for multifamily is still very, very strong. The second thing we like in the sector of multifamily is that it became obnoxiously expensive to buy. Here's a list over here of renters versus acquirers, property owners. So if you look at this list, we've got 15 different major markets, and we're comparing here the difference between what would be the salary that you would need in order to buy a median house in a place like let's look at the first market, Tampa, Florida. In 2020, a median income to buy a median house in that area in Tampa, you need to make around $32,000. In 2022, your salary should have increased by 123% to $72,000 in order to afford a median type house in this market. And the list goes on. I mean, look at those numbers. In Austin, 116% increase on your salary. You needed to make $103,000 to be able to afford the median house, where previously, it wasn't just a couple of years ago, you could have bought a house with a salary was just as little as $47,000. So what does it mean for us? It means that the demand is strong, and the demand will most likely will stay consistent. Because how many people do you know that had an increase in salary of 116% or 123% or double their salary, just 100%, right? From 41, like in a place of Phoenix, Arizona, you could have bought a house with a salary of $42,000. Today, in order to buy the same house, in order to qualify, you need $85,000. Obviously, two impacts. First, everything went up in value. Immediately after the pandemic, everything became double. Okay? Almost in all markets, everything became double. There was not enough inventory. Everyone was out there. It was government money flooded everywhere into all directions. Interest rate was like 2%, 2.5%, 3%. Everything was available. And so that created tremendous push on valuation. Today, on the other hand, right, with interest rate being around 6.5%, 7.5% on a 30-year mortgage, you need to make a lot more money in order to afford the very same house. And so we know that a lot of folks are going to be simply priced out of the market. And when not the ability to buy a house, you're going to stay and look for something to rent. Next one, please. The supply chain disruption was a long conversations. There was real big issues to get material. It was very, very hard to build, right? Very, very hard to build. Very hard to find material. We've had amazing stories. We were building in Columbus, Ohio, cold storage facility. And I'll take a couple of minutes just to explain what a cold storage is. I mean, obviously, the storage industry became the darling of the real estate segment for the last several years. We're seeing the bricks and mortar shops and stores are becoming less and less popular, certainly in big malls and regional malls and stuff like that. And so a lot of us are actually buying our goods online, right? So that's sort of like the story of industrial fulfillment centers. I don't need to go and buy my jeans. Let me go online. There's plenty of pictures. I know what my size is. 2 clicks of a mouse. Here's my credit card. and the next thing you know, Amazon delivers next day. The demand for places or fulfillment center became tremendously large, and more so as we were being locked in during the pandemic. We were not able to come out. We wanted to get our goods and services. One of the segments within this industrial segment is called the cold storage. So the cold storage is effectively represents maybe 1.5%, maybe 2% nationwide of all the storage facilities located in the United States. Boom. We're talking about a tremendous undersupply and a tremendous demand. We are now buying our goods and services. I know my wife buys our groceries online. We get those tremendous boxes. They show up at our doorstep within a couple of hours of clicking the mouse, and wherever everything is fresh, everything is available to us. The demand for cold storage has been growing exponentially to the tune of about 600-700% year over year, with no shortage of stopping in the next several years. It's very hard to build cold storage. So of course we love this segment. We acquired a cold storage in Columbus, Ohio. And so as we were going through all the effectively all the segments of building it and renovating it and bringing it up to speed, it was extremely hard to get material. We had to seek for material from China. We had to seek for material from other locations throughout the world. It was just very hard. Supply chain became a real big issue. And so that is also kind of like, waned down. And so we see a lot more openness in that space. Tight labor market has also loosened up. It was very hard to hire labor. So why am I telling you all those things? I'm giving you this notion because before you choose an asset, I want you to choose a time. You can go to the next slide, please. I want you to choose a time. Understand that where you are in time is a very important factor of your determination of what you should be investing in and why. Right? So before we talk about asset class and how to choose an asset and how to choose a partner, let's talk about the economy and where we are in time. The other thing that we look for is the huge supply in 2023, putting pressure on rents. So we're looking in 2023, anything that comes up to the market at this point finds a lot of competition. There's been a lot that's being built, in the last couple of years. Interest rate, again, was very low. Everybody wanted to put money into real estate, and the demand was just through the roof. We're now feeling the pressure of all those thousands and hundreds of thousands of apartments coming in all at the same time, right? Same thing will happen in 2024 and a lot less in 2025. So that's something to pay attention to. The demand, obviously, is a number one game here, right? It's always down to supply and demand. And so when we choose an allocation of where we want to put money, one of the things we ask is in this particular area, right? In this particular area, do we want to be in multifamily? Do we want to be in residential? Do we want to be in hotels? What it is that we want to be, and that's a question has to do with obviously employment and also supply chain and also what's available and what sort of a pipeline that's happening right now. Okay, move on to the next one, please. And so to sum up this conversation, where we are in terms of time, I believe, the market, you can kind of like look at the market in three different segments, right? If we'll say that the market cycles are anywhere from 9 to 12 years on average, okay? So the market goes through kind of like a stabilization period, right? Where money is available, cost of capital is reasonable, and there's kind of like a very creative type of a period where there's a demand for more investments in real estate. That's usually 3 to 4 years type of a period. Then it reaches a euphoric period where everyone wants to be in real estate. Everybody wants to buy real estate. People are willing to pay abnormal amount of money for it. It's also, everything is based on future projections and everything is rosy. Money is plentiful. Transactions are plentiful. And that's sort of like a dangerous period for us. You got to watch out for that period. It's the bubble. Usually it tends to be the bubble period. That's the last 3-4 years of every cycle that you want to be very, very careful. If you think about the last couple of years, that rosy period has happened late 2020 into early 2021 and ended sometime around the summer of 2022. I'm sorry, 2023, 2022, pardon me. And then after that period, when the bubble burst, if you will, we're going to a downward period where there's a lot less capital available, a lot more people sitting on the sidelines, real estate values are dropping, and that's the period that actually represents the biggest opportunities. So where we are in the market, according to fundamentals, according to my crystal ball, and of course my crystal ball can be murky sometimes, we are at the bottom. It's been well over 20 plus months since the peak in March of 22. We're probably going to continue throughout some form of a bottom so long that the Feds are going to keep interest rate high. However, the Fed's objective is not to bring the economy into a recession. If they'll continue like this, we're certainly going to find ourselves in a recession. Inflation is down now from the peak of 9.6% to around 3.4%, give or take. The last couple of months, real inflation month over month have been 0.01% change in inflation. This is now the third month that we're seeing no change in inflation. We are probably coming down into where the Fed wants us to be, which is the 2 to 2.5% scenario. The Feds will wait a little bit before they'll start rolling back on the interest rate. And so it'll probably happen sometime in the late first quarter, maybe into the second quarter of 2024. And their analysts from all the large banks are predicting anywhere from 75 basis points to as much as 175 basis points drop in the 10-year treasury. And if that should happen, we're going to be looking into a very active market towards the later part of 2024 and certainly a much better market into 2025. So I wouldn't be a seller. I'm all in on the market right now as a buyer. Any questions so far before we'll skip to the next topic of how to choose great investments?
Hey, Joe, we've got a couple that have popped in already. The first one is you referenced a return average of 21% for your investors. I guess the question would be over what range of time, and if you could break that down into maybe what the range has or what the return has been over just the last couple of years when we've been in this decline.
Sure. So we're tracking 20, this is obviously 21% cash on cash average per year net to our investors after all fees and everything else that you can think of. So we deploy capital in three different ways, right? We either deploy capital through debt. When we deploy capital through debt, the return the investors see somewhere in the vicinity of 10 to 14%, I would say, right? Net to the investors. A lot of time it's paid quarterly. It's a cash flow type of a situation, and it fits certain part of our investors, not everybody else. And then the other two methods of deploying capital is through common equity, which means we participate, our investors participate with us as partners in a development or partners in acquisition of a building. And so, what we do is either we build and create a lot of value in a short period of time, or we improve, right? Like in the case of the deal in Texas or in other places where we bought a building, improved it, increased the value, found the right market, sold it at a nice profit, and then distributed. The 21% is essentially around that sector. So if you're in the sector of equity, 21% is our average. We've had deals where our investor made 43, 45% per year. The duration was short, 2 years. We lucked out. We were smart enough to understand that market, that short window where it was euphoric, right? Right after the pandemic, it was euphoric. Everyone was buying. Everyone was willing to pay top dollars. Money was plentiful. The interest rate was at the absolute bottom. And so it made sense for us to sell, even although we kept the property for a short couple of years, maybe even less than 2 years. We just knew it was the right time to dispose of assets. Other assets, we aim for about 24%, 25% if we're building condominiums. Again, yearly annual return, and that's based on development. Usually our projects don't go longer than 4 years. There's some exceptions. Some of the larger projects that we've done projects of 100 condo units, $200 million projects. They tend to go longer a little bit, certainly because of the pandemic had a lot to do with it. When typically we would have 100, 120 construction workers on a site on a given day. Some markets wouldn't allow us to have more than 25 or 40 different individuals working because of COVID rules and so on. So things took longer. When things take longer, the interest rate, the clock is ticking with the bank all the time. So interest rate is ticking and everything is ticking. Everything became a little bit more expensive. The returns were a little bit lower as we went longer. So most of the deals that we've done that got stuck. So in other words, we started the deal in middle of or late 2018, and we went through the pandemic period. Instead of finishing around 2021, we might have finished around 2022. So it took us another 6 months or a year longer. The overall annual return shrunk. If we expected a 24% return, we had to stay a year longer. Maybe the investors made 18% return. The overall return, cash on cash, still stayed around the same numbers. When I say 21%, I'm talking about average. We, thank God, knock on wood, for so many years of operation, we've never lost capital, never had any loss of capital. But we've had a deal that didn't do so great. The building is amazing. I think we're probably going to generate a single-digit return. So I'm taking all of those into account, from those that we've kind of like hit the ball out of the park and returned our investors 45% per year return, and those that we return to the investors, 6, 7% return. Those are the outliers. The middle ones tends to be around 18 to 22 to 24% annualized return.
Perfect. Thanks. The other question, out of the 2.27 billion, how much of that capital have you deployed, and what's the split on institutional versus non-institutional investing?
So we're backed institutionally by a group from overseas. Whenever we go to a transaction, essentially first we'll underwrite together with our partners. We'll underwrite the deal, and then we will bring somewhere in the vicinity of 70 to 80% of the check size from the institutional group, leaving 20 to 30% of the capital to my own money, my family's money, and that is of our group of friends and family. Okay, well, we have over 300 high net worth individuals that invest with us fairly consistently, with some of them with small checks, others with larger checks, but fairly consistently been investing with us over the very many years. $2.25 billion represents obviously the full mark to market of the gamut. If I'll have to pull away our portion, Astor Realty Capital portion, that is associated with this, I'll probably say that it's somewhere in the vicinity of around $550 million that belongs to us, right? Belongs to Astor's investors and so on. Obviously, the rest is other investors outside of our group, the various sponsors that we work with, and of course, a big chunk of it is the mortgages, right? The banks that we utilize in each and every one of those projects. So I hope that answers the question.
It does. Thank you. As part of your transition to, as the market is in its down cycle, and you're thinking about buying, are you thinking more at this point about land in prep for build in future years? Are you thinking about still trying to find value add, and people are being credit crunched and all that kind of stuff? Where's your thoughts right now on best opportunity?
So I think the most of the opportunities today, and there's certainly a lot of opportunities, and there's going to be more to come. There's not everyone's able to recapitalize the transactions. Imagine what I gave an example before of the Dallas example, right? If we wouldn't have looked out and were conservative in our approach and we wouldn't have bought a rate cap, we would have find ourselves in a very deep trouble, right? And so, a lot of folks are in that situation, which means they need rescue capital. And that's something that we, for the right type of opportunity, we'll be very happy to come in and create some sort of preferred position, some sort of a rescue capital to the right projects and the right sponsors. So those are opportunities that we like, of course, on a very select basis. Other opportunities, we may not be playing in those opportunities too much, but those will be distressed notes, right? There's a lot of that floating around, a lot of distressed notes. It's not necessarily our game for a couple of reasons. First, I don't want to be at the opposite end of somebody who's suffering. That's just not my personality. I don't want anybody to ever do that to me, and I certainly don't want to do it to anyone else. I understand it's a great business. Essentially, distress note means that you are now buying a mortgage secured or collateralized by an asset that used to be worth a lot more, and you're buying the note for a very deep discount. And so you're sort of like, the way to actualize return to your investors is to force a sale or to foreclose on the asset itself, which means a bunch of investors will be losing, not ours, right? But a bunch of investors somewhere will be losing all their money probably. And then you will gain because you were able to squeeze them down as much as you could. And now you're waiting for the market to change or anything like that. That's just not what we like to do. That's not who we are. That is not to say that if we are on the lending end and we have a bad borrower, we wouldn't deploy it. I mean, obviously we have it, but it's just not our personality. We would love to make money, but we'd like to do it in good vibes. Let's just say that. So I know that there's a lot of opportunity there, but it's not an area where we're focused on. The conversation of ground up became extremely selective. And the reason for it is because when we build, we look to build for around a 6.5, 6.75% cap rate or yield on cost, right? So in other words, if I'm building a building, I'm just going to throw a number. If I'm building a building for $100 million, I want the actual rent, the net rent for this property to generate for me around $6.5 million a year or $6.75 million a year once it's stabilized, and still increase some of the upside potential, which is great. The only issue is, if I could buy today at around a 6.25, or even 6.5 cap rate, why would I be taking all this extra hassle to build a building for the next 3 years, right? So that's sort of like where the conversation is. Now, I know a lot of folks saying that, they'd like to buy for 6.5 Class A apartment buildings. I haven't seen many of those. I mean, they're so rare. They're unicorns. All right, they truly are unicorns. Yes, there's discounts. We spoke about it. I started a conversation that the market is down, big to trough, but we don't see too many trades. Why? Because the banks are not forcing any sales. They're extending, what we call extend and pretend. They've learned from the last recession and from the last kind of like shake up in the markets in 2007, 2008, 2009, that those that have squeezed their borrowers and took over properties found out that they sold too quickly, too soon. They probably took big discounts. So many of the banks, the smarter banks, are not actually pushing borrowers out. And there's plenty of capital, like I mentioned, rescue capital. It doesn't require for anybody to kind of like get squeezed out entirely. Having said that, every exception and every rule has an exception to it. We're now working on a transaction that we're very, very excited about with a fantastic partnership to build 220 apartments in a wonderful area, Orlando, MSA. And, we've mentioned that construction is down significantly. In fact, construction starts is down 70% year over year, which means a lot of projects, they either never got out of the ground because it's too expensive to borrow, it's too expensive to raise, it's very hard to raise capital. And so we see opportunities in certain markets where we know we may be looking for a yield of a 6.5 cap rate, but we're going to have very little competition come 2026, come 2027, when we're going to place the building on the market for sale. And we're probably going to enjoy 200, maybe 250 basis spreads. In other words, we're looking to see a big, big return on the risk of going into construction at this particular stage. The second benefit of that, of course, is with less construction out there, the large general contractor, the GCs, are essentially not going to be as tough as they are on cost, and everything is coming down, labor is coming down, less construction available. You're a GC and you want to keep your team and you want to keep your trades, got to put them to work, right? So you're going to compete better and give us a better price point, so we'll hire you.
Great, thanks. One last question. What's your typical LTV, loan to value that you're running on your projects?
Really depends on the project and really depends on a number of factors. I'll tell you how I look at a loan to value in a philosophical way, and then we'll talk about why I'm less concerned about the loan to value and more concerned about something different. Whenever we go into a project, I also take the stand that the world will go upside down, right? If I'm building condominiums, if I'm investing in a condo project, I'm going to assume that sometimes in the next 2, 3, 4 years, the condo market will dive down and there will be no market. So my question is, if that should happen, I certainly don't know if it will or will not, but I have to assume that it will. And if that should happen, can I preserve capital? By taking this building, I'll have a building, right? I'll have a brand new building. There's construction guarantees. The bank is there to lend me. Everything will happen. Completion guarantees. I'll have a beautiful building, but there's no market for condominiums. So what happens then? Can I rent the asset? And if the answer is no, if I cannot rent the asset, refinance my construction financing, keep my head above water, and float for the next couple of years until I can maybe come back to the market and try to sell his condos again and make a profit that way. The answer is no, I cannot refinance. My mortgage is too high, and I'll reduce it. So we analyze not just the business plan, but also the second plan, a plan B, right? The what if type of a scenario. Now, I've mentioned before, this year alone, until the end of November, my analyst told me we've looked at 840 transactions. 840 times, folks from across the United States came to us with a beautiful package asking us to participate in deals. This is as of November. In a year that is, a lot less is happening. We say no to deals because many times plan B doesn't work. And if I don't have a second mean of exit, if I don't have an exit plan outside of my regular exit plan, if my elevator in my building doesn't work and I don't have the staircase when there's a fire, then I wouldn't go into this building, right? And I wouldn't go into this transaction. So I will time the loan. I will look to seek the loan that will be the most creative, but also will take into account that I can refinance, keep it if the worst should happen. Now, what does it mean in terms of loan to value? Look, 65% doesn't give me the type of returns that we're looking for. So we typically have 65%, and then maybe there's going to be another layer of preferred equity to 70%, maybe 75%. I think we feel comfortable between 70-75%. In special situations, we might feel okay with an 80%, but everything has to be like super aligned. All the stars have to be fully perfectly aligned for us to feel comfortable with that. And that's typically where we'll see topping off. So 70-75%, providing we know with a big assurance that we can refinance out of a construction loan, that if things should change, we're able to sustain and keep the asset. Keep in mind, preservation of capital is the most important thing. It's not how much money you can make to your investors. It's can you preserve their capital first? And a lot of times in many deals that we see, the answer is no.
Perfect. Thanks, Joe. That's questions we have. You can feel free to continue.
Sure. Okay, I'll go through this very quickly. So the second segment here is, we spoke about kind of like the market and how to choose and how to time the market and understand where you are. So if you understand where the market is, and you know where the opportunities are, but you also need to understand where the risk is. Now, outside of timing, right, there's another segment is, you got to love your collateral, the real estate. I call this conversation turning the triple C to a triple A. So the triple C, okay, the collateral, the real estate. You need to understand the real estate. We go through a very, very heavy check 60-point check, the diligence check, my team, but that goes into the legal, that goes into the background, that goes into the understanding the dynamic of the area, why we want to be in the area. One of the most important segments is employment. We want to be in booming area where there's multiple employment possibilities, multiple area, big gamut of employment. We try to stay from one horse town. This is why you'll see our assets focus primarily on gateway cities because there's a big diversification. There's just the kind of dynamic that we look for, and we look for areas that have a lot of growth, right? So other things that are important to us is barrier to entry, but it's extremely important to understand the real estate. If you're not a professional, if you're a doctor, a lawyer, a mechanic, whatever it is, and you're seeking to invest locally, unless you invest with a group like us, invest locally, okay? Invest in an area where you fully understand the market, where you fully understand the real estate. And that's extremely, extremely important. So we track a lot of markets, we track a lot of areas, and a lot of asset classes. That's the first C. The second one is credit. The second C is credit. So what's credit about? I want to know that when I partner up with a developer, with an operator, I want to know that first of all, they have the capacity to bring a reasonable loan. I want to know that they have money, that they can put money, skin in the game, right? Those with skin in the game stay in the game. I never go into business where the only side that actually put money is going to be us. Because those without skin in the game, it's easy for them to stay out of the game, right? First sign of issues, you can always walk away from it. Not so much how we do business. I want to see about an 80-20. A lot of times we'll bring 80% of the capital and our partners will bring 20% of the capital, but we must see that they have skin in the game. Issues happen, right? There's capital calls. You build a building, it takes longer, material change, cost overruns, sometimes force majeure, sometimes nothing to do with the developer or GCs or anything like that. We want to know that our partners can put their hand into their pocket and put the extra 5%, 3%, 2%, whatever is needed in order to make sure that the project continues. So the credit is extremely important. Understanding the credit is extremely important. And when we do our analysis on a partnership, we don't just look at this one asset. We also look at all the other assets that our partners is currently building, owning, holding, kind of like a whole different analysis, cash flow analysis, to understand the financial strength. And then the part that I think is spoke about least, and for me is the important, probably the most, is the character, the last C. The last C essentially is the ability to understand our partner from almost a psychological standpoint. What sort of a person is? What kind of a partner is he going to be for us during the next 3 years of this investment? Am I going to have to chase this partner down for reports? Is he going to keep the stories for me, the heartaches for me, or anything like that? And I'm only going to find out about them when it's too late for me to do anything about it. Are we going to have transparency between us? Are we going to see eye to eye when we have to make decisions on major issues? Those things are impossible to put in an Excel. So it's my job, well, it's my team's job to find the assets, analyze the assets, and bring the right real estate. It is my job to go out there, fly out there, sit with our potential partners and understand the type of environment that they live in, the type of group they have surrounding, how much experience they have. But the most important thing is what type of people they are and what sort of partners they're going to be to ourselves and to our investors. See, I've been in this business for about 28 years now. I started from New York City, one of the most competitive markets in the world. I focused on very large transactions, large-scale transactions, and as an intermediary representing banks and borrowers, representing the state of New York and the public, representing buyers, sellers, capital raised people, you name it. I've done probably several hundred, maybe over 400 transactions in my career, over $4 billion. I've seen the best in people. Unfortunately, or maybe for this business, fortunately, I've also seen the worst in people. And so over time, I've developed the ability to listen and listen very intuitively and found a way through conversation. I know that people tell me everything. I just know how to ask, and I know how to focus, and I know how to listen in such a way to get the information in order for me to make a determination. Because imagine my job is to determine if you, my new partner, are going to be a good partner for the capital that we're looking to deploy. And so, we're talking about 30 years of experience at this point. And so I think we've picked up this talent. I think I've picked up this talent and perfected it over the years. That doesn't mean that he's perfect, of course. It doesn't mean that there's no room for mistakes. I assure you, nobody's perfect, and we know that. And but I think it's important to be able to understand that. We can skip the due diligence part. Obviously, due diligence is extremely important. We go through months of due diligence on every asset before we actually say yes to any deal. And that describes everything else that I touched on right now. Asset management is extremely important for you, the investor, knowing to do the asset management or to make sure that you teamed up with a group that does asset management. What does it really mean? As an investor, you'll get an opportunity presented to you. You'll hopefully do your right type of due diligence. You'll call people that you know in the industry. You'll get second opinions. You might call your accountant, your attorney, have somebody look at the presentation and ask the right questions. Check around yourself, do some Google search, see what type of people you want to work with. The factor of asset management basically means after you close the deal, what sort of work is being done? Okay, what sort of work is being done on the asset from your side, from the investor side, to make sure that your capital at risk is being treated as it should. Where we come into play, and we can only speak about ourselves, but we're not the only ones out there. We've created something called the collective bargaining. The collective bargaining essentially means that we as a group, right, myself, my investors, the capital behind us, as a group, we're much stronger when we come in together. If you think about the typical investment style, right? You'll have a developer who would give a great presentation, say, come invest with me. I'm going to build a great building here, and you'll make such and such a return. I'll split with you the profits above a certain hurdle and so on. Typically, a small investor, $100,000, $200,000, $1 million will come in and get whatever terms everybody else is getting. However, in a case of collective bargaining, in our case, you, the investor, have a very different option here that I want you to consider. If we as a collective don't come in with a check of $100,000 or $500,000 or $1 million, if we show up with a check of $10 million, if we are the major check, our group, the major check, maybe 70, 80% of the ownership of the project, then we're going to get much better terms. We'll negotiate much better terms with our operating partners, the developing partners. We're going to negotiate a lot of more legal rights. Okay, it's all about the legal rights, our right to make sure that we have major decisions. You cannot change the business plan. You cannot change the budget. If there's any neglect, if there's any issues, we'll know about it because we do our asset management. We have professionals that go and track how money is being spent, how are we on time, are we on budget, and we get that reporting, and we report that over to you. We have a takeover provision, which is a very, very scary thing to developers. The ability to say to the developer, Mr. or Mrs. Developer, you've messed up so bad. And we gave you enough opportunities, but now you're off the project. You're out. We're going to finish the project ourselves, or we'll get your competitor to come in and finish the project for us. So we have all those control rights. Now, I think it's extremely important. I think maybe I'll drive the major point here, and maybe the last point, because I covered a lot, is before you invest in real estate, make sure that you have good partners next to you. Good partners. And I don't mean the kind of partner that can build. I mean the kind of partner that can help you make the right allocation of the asset, that can get you the better deal, because as a collective, you'll negotiate better terms. And make sure that there's teeth, right? That there's teeth in this agreement that you sign with the developer, and make sure that there's somebody there to watch how the investment goes over the course of the next 3, 4, 5 years, 2 years, whatever it is, and report to you. And if there's any issues, he's on your side. It's very different when you, as a small investor, has to negotiate with a large developer that controls all the shots, that tells you whatever he thinks he or she wants to tell you, that reports to you whenever they feel like reporting, and reports and know for a fact nobody's there to check. So we're kind of like changed the way things go. And as a collective, I think we're a lot more powerful. And yes, we make money when our investors make money. That's part of our business plan. We make money when you make money. My money, however, takes the exact same level of risk as anybody else, anyone else from our investors. And I think that's the final point I want to drive home. The asset management and the collective bargaining is extremely, extremely important. Team up with other professionals like yourselves. There's power in numbers. You'll negotiate better with a larger check, and you'll have all the mechanism that you'll need in order to make sure that things are going according to plan and according to budget.
Thanks, Joe. Really, really appreciate it. That was really, really informative. Did you want to, or Lara, did you want to share any of your contact details before there we go. Before we break out? I know we're at the top of the hour, so people probably need to be dropping, but.
Sure. We please stay in touch with us. You can take down this QR code. Laura and the teammates have make sure to include you in future webinars. We have webinars on all sorts of topics and all sorts of projects. And then, of course, whenever we sign a deal and it's time for us to do a capital raise, I'd love to invite you. I'd love to have you be part of our growing club of friends and family. As I mentioned, on every project that we do, we typically bring a large institutional group that comes in with us, take the lion's share, and then we typically leave the last $2-3 million, $4 million to our club of friends and family. We invest together. So you have access to high quality real estate. We've been around for many years. I've been around the block, as I mentioned, close to 30 years. And I'd love to, have you reach us. You can schedule a one-on-one conversation with me or one of the teammates. And would love to keep this conversation alive and going. I really want to thank you all for your time, and I want to wish you a fantastic weekend. Take care, everyone.
You too as well. If everyone could take their cells off mute and say thanks to Joe.
Thank you, Joe. Thank you, Laura.
Thank you.
Thank you.
Thank you, Joe.
Thank you.
Thank you, Laura.
Thanks,
Yeah,
Joe.
thank you, Joe. Thank you.
Speaking
Great
soon.
presentation.
Thank you
Thank
so
you.
much, everyone.
Good weekend, everyone.
Take care.
Thank you.
All right, thanks so much. Take care.
Thanks, Glenn.